The tips in this video are for the average investor, people who don't spend their time obsessing over the markets and investing, who just want a simple strategy that they can use for investing regularly over time. So here we go. Tip number 1, don't try to time the market, meaning don't try to buy and sell investments based on your or other people's feelings or predictions about economic or market conditions. Humans are notoriously bad at getting the timing right. We often sell when we get nervous, which is usually after asset prices have declined, only to watch them shoot back up from there. And likewise, we tend to buy when things are looking good, but at that point, prices have already run up a bunch and may decline from there. Also, people try to get fancy and wait for a pullback in price to buy, but then the pullback doesn't come, or we get nervous when it comes down, so we don't buy. We end up staying on the sidelines. It's better to just dollar cost average in, meaning buy at regular time intervals to establish your position in an asset. Tip number 2, don't buy individual stocks. Instead, buy a mutual fund or an ETF that tracks an index like the S&P 500. Even the experts have a tough time picking which stocks will perform well and which ones won't. As individual investors, it's a fool's game to think we can do our own research and pick stocks that will beat the index. That's not to say that if you pick 10 stocks, a few won't beat the index. They might. My point is that it's unlikely that the portfolio of those 10 stocks would beat the index. So just buy the index. Tip number 2.5. This one's important, so pay attention. If you drop a like below the video and subscribe to the channel, only if you're enjoying it, of course, then there's a near 100% chance that I'll continue the video and share the remaining tips. Go ahead, try it and see. I'm pretty optimistic. Thank you. Tip number 3, in the equity portion of your portfolio, meaning the stock portion, include indexes that include all sectors of the economy and all sizes of company. If you include only the S&P 500, then you're including only 500 of the largest US companies. If you buy only the NASDAQ Composite Index, then you're including about 3,000 companies, with tech stocks making up about half of that. Both of these indexes omit a portion of the overall US stock market. As average investors, the best way for us to reduce risk is to diversify. So my advice is buy indexes that cover all stocks, not just some stocks. Another benefit of doing this is by default you'll be getting paid dividends within the indexes, and dividends are an important part of equity returns. Tip number 4, include bonds. Bonds have historically been an important diversifier of risk in a portfolio. On rare occasions, such as in 2022, both bonds and stocks ended the year down, but most of the time they move in different directions, or when they move in the same direction, it's by different amounts. For the bond portion of the portfolio, I'd suggest splitting it up into bonds of different length and include both government bonds as well as bonds issued by companies. Like with stocks, you can do this by buying bond index funds or ETFs. There isn't universal agreement as to how much of your portfolio should be in bonds versus stocks, but a common rule of thumb would be to put 60 or 70% in stocks and the rest in bonds, with the idea being that as you get older, you'd put a larger percent of the portfolio in bonds versus stocks if you need the money to live on. If you don't need the money to live on and are a long-term investor, then you might keep more in stocks if you're comfortable with the higher potential volatility because of the higher total return potential on your portfolio from doing so. Tip number 5, for both the stock and bond portions of your portfolio, consider putting a good portion, maybe half, in international stocks and bonds. The US stock market has outperformed most of the rest of the world for quite a while, but as a result, it's also quite a bit more expensive than most of the other world markets too. There's no guarantee that the US will continue to outperform, so it makes sense to diversify internationally. Also, the world is starting to shift away from the US dollar being the primary currency, so it's possible the US currency will weaken over time if demand for the dollar decreases. And if that happens, you'll be glad to own international investments. If you've made it this far in the video, next is the bonus tip. But before I share it, I'd like to request that if you have a tip that could make sense for most investors, please share it in the comments below the video so we can all learn from each other. Here's number 6, your bonus tip. Rebalance your portfolio on a regular basis. At some regular time interval, maybe once per calendar quarter or once a year, make sure that your portfolio has the desired percentages in stocks versus bonds and in international versus domestic that you wanted. For example, if you want to be 70% in stocks and 30% in bonds, but stocks performed well last year and now make up 80% and bonds only 20%, you would sell enough stocks to get you back down to the 70% target and invest that cash in bonds. Just make a note on your calendar to remind you to do this. One important thing to note here, though, is that if you own these stocks and bonds in a brokerage account instead of an IRA or 401k or similar tax-advantaged account, then rebalancing will create a taxable transaction. So maybe discuss how to manage that with your tax accountant if you use one. If, however, you own the investments in an IRA or 401k or some other tax-advantaged account, then rebalancing should not have any tax impact. Again, confirm with your accountant. Remember though, we're rebalancing to manage the portfolio risk, and paying some taxes may be a reasonable price for that. But it's up to you. Hope that was useful. I'll see you in the next one.